The world doesn't collapse with a bang. It collapses quietly. At first, nothing looks broken. Shops are open, phones work, stock tickers still blink green and red. But somewhere in the background, something vital has already snapped. And by the time most people notice, it's too late to stop. Every global economic crash in history starts the same way. Not with panic, with confidence. Right now, the global economy looks busy. Trillions of dollars move every day. Governments keep borrowing, companies keep reporting profits, central banks keep smiling calmly into microphones. And yet, underneath all of this motion, the system is tighter, more fragile, and more stretched than it has ever been. This matters now because for the first time in decades, almost every major economy is under pressure at the same time. Growth is slowing, debt is exploding, trust is thinning, and the tools that once saved the system are nearly exhausted. To understand why this is dangerous, you have to understand how the modern global economy actually works, not how it's described, but how it survives. At its core, the system runs on one idea: future growth will pay for today's promises. Governments spend more than they earn, companies borrow to expand, consumers swipe cards for things they haven't earned yet. This is not a flaw, it's the design. Debt isn't the enemy of the system, debt is the system. As long as tomorrow is bigger than today, everything feels manageable. Old debts are rolled into new ones, interest is paid with more borrowing. Asset prices rise, making everyone feel richer on paper. Confidence feeds growth. Growth feeds confidence. But this loop only works if growth never meaningfully slows. And that's where the math turns uncomfortable. Global debt today is not just high, it's historic. Governments, corporations, households, all leveraged at once. The system is no longer supported by productivity alone, but by expectations. Expectations that interest rates will stay manageable, expectations that currencies will remain trusted, expectations that nothing breaks at the same time. But reality doesn't move in expectations, it moves in constraints. Inflation exposed one of those constraints. When prices started rising, central banks were forced into a corner. Keep rates low and inflation eats purchasing power. Raise rates and debt becomes suffocating. So they raised rates. And that single decision quietly changed everything. Higher rates don't just make loans expensive, they drain oxygen from the entire system. Governments pay more just to survive. Companies cut investment. Consumers pull back. Asset prices wobble. Weak businesses fail first, then stronger ones feel the pressure. This is where crashes don't look like crashes yet. They look like slowdowns, like soft landings, like temporary adjustments, until they don't. The real danger isn't one bad economy, it's synchronization. In past crises, one region could stumble while others carried the load. Today, that buffer is thin. When the US slows, global trade feels it. When Europe struggles, financial markets react. When emerging markets wobble, currencies break, and capital flees. And all of this is happening while geopolitical trust is eroding. Trade is no longer just trade, it's leverage. Supply chains are no longer optimized for efficiency, but for control. Money itself is becoming political. Sanctions, tariffs, currency weapons, these aren't theoretical anymore. They are active forces shaping the flow of global capital, which introduces another uncomfortable truth. The global economy is not just an economic system, it's a confidence system. Currencies work because people believe others will accept them tomorrow. Bonds work because investors trust governments to honor them decades from now. Markets function because participants believe rules won't suddenly change. Crashes begin when belief weakens, not disappears, weakens. When investors start asking questions they didn't ask before, when lenders demand higher premiums, when consumers hesitate instead of spending, when institutions stop trusting each other fully. The irony is that the system often looks strongest right before it breaks. High valuations, calm headlines, reassuring statements. History shows this pattern again and again. Stability breeds risk-taking. Risk piles up invisibly. Then a trigger appears, sometimes small, sometimes absurd, and the system realizes all at once how fragile it has become. The trigger is never the real cause, it's just the spark. The real cause is always the same: too much leverage built on too much confidence for too long. Today's leverage is not just financial, it's psychological. People assume central banks will always intervene, that governments will always bail out, that markets will always recover quickly. These assumptions are powerful, they delay panic, but they also concentrate risk.
Because if everyone believes the safety net is infinite, no one prepares for when it isn't. This doesn't mean collapse is guaranteed tomorrow. Crises rarely follow calendars, they follow pressure. The pressure right now is building quietly, in debt markets, in currencies, in political systems, in households stretched thin by costs that rose faster than incomes. What makes this moment different is not that the system is broken, it's that the margin for error is smaller than it has ever been. There is less room to cut rates, less room to borrow cheaply, less trust between nations, less patience among populations. The system can absorb shocks, but it cannot absorb everything at once. So the real question isn't whether a global economic crisis is possible. It always is. The real question is simpler, and far more unsettling. In a world built entirely on confidence, how much confidence can disappear before the math finally takes over? Because when that line is crossed, the collapse won't be loud. It will be quiet, orderly, and already unavoidable. And by the time it feels real, the story will already be over.